They don't want what we know out there.
How a person can go from really almost nothing to becoming a millionaire by owning rental properties.
He would always buy these flip houses, and I just remember thinking, this guy is crazy. Why would he buy that house?
In the past decade, there's been a huge surge in the peer-to-peer short-term rental market.
Become an insider. So you have to know the rules before you get the game.
Every second counts. So make every second count.
Welcome to the Real Estate Jam. Whether you're just beginning or the best of the best, we're glad you're here. We will share successes, failures, and strategies for the action-taking real estate investor. And now to your hosts, JD and Melissa.
Hey guys, welcome to the Real Estate Jam podcast. I'm JD with my wonderful co-host.
Hello, JD.
Melissa. Melissa, thank you so much for being here on time.
Thank you. Happy Monday.
Happy Monday. The week just flies by, you know what I'm saying?
For sure.
Awesome. Well, we have a pretty good show today, and it's something that we've talked about a few times, but I'm sure that we're going to get a ton of information. It's an important part of real estate investing, especially as you start to run out of time to manage your own rentals and deal with tenants, termites, and toilets. So I'm excited to introduce Scott Carson. He's the CEO, founder, chief bottle washer of WeCloseNotes.com. Scott, thanks for coming on our show today, man.
Thanks, Scott.
What is going on, y'all? I'm doing great. Happy Monday. It's a good day, right? It's always a good day when you're 6 feet above ground, but honored to be here, honored to give, and congratulations. You guys are just doing amazing things with the show. So honored.
Thank you.
Awesome.
Thank you. Ditto.
Yeah. We really appreciate your time. Scott, I'm hoping that you wouldn't mind introducing yourself to our audience and letting people know who you are and why they should listen to you.
Yeah, no problem. I'm just a crazy guy out of Austin, Texas. You know, I've been an active real estate investor for over 20 years now. Wow. Hard to believe that. But I focus on the niche, a niche within a niche of real estate where I buy notes. I buy distressed debt. I buy distressed mortgages. I'm known across the country as the note guy. And I know most people, when they think of notes, they think of like owner financing, buying on terms. And that's an aspect of note investing. But I'm a little bit different. I like to say I'm on the sexy side of real estate. You know, if you're a fan of Christian Bale or Brad Pitt, you've probably watched The Big Short in the past, which is a great movie. I'm kind of like Christian Bale's character in that movie, where I'm buying individual or portfolios of mortgages, you know, first liens on residential commercial properties direct from banks. And the fact that I'm targeting non-performing notes, which what that means in layman terms, that's where somebody hasn't paid their mortgage in a period of time, either 6 months or 6 years in a lot of cases as well. So we go into these banks and different investment firms across the country, and these banks will sell us their debt, sell us their notes, their mortgages, usually at a pretty significant discount, usually below 60% of as is value. Wow. And so we buy that debt, literally step into the bank's shoes, and we become the lender, and we make our money. And that's what we're all about, is making money, baby. Right. You know, is how we make our money. Since we're the bank, we now can reach out to the borrowers and say, hey man, what's going on? You know, what's the country western song that's happened to you? Did you lose your job, get divorced, grandma got run over by a reindeer, you know, whatever it is that you couldn't make your mortgage payments, COVID, whatever. Let's get you back on track. You know, I know you're behind by a year or 2 years. Can you start making your existing payment again? And so, you know, if they can't make a payment, do you want to sign the property over to us and walk away? You know, do a deed in lieu, or we will, often incentivize them with cash for keys. They won't do that, or they just tell us to go pound sand, give us the bird. We give them the bird back by just, putting the file with our attorneys, and then our attorneys handle the foreclosure process and that kind of stuff. So we literally become the bank. You know, don't get me wrong. I do, I originated a ton of owner finance notes back in the years, and we do buy on terms too. On our other side, we offer terms on our real estate a lot of times too, but we're literally buying the debt from the banks and becoming the bank. And it's a beautiful thing. So we don't deal with the 3, or I guess you say 4 T's. You forgot trash outs on your first, you know what I mean?
That's my favorite part.
Exactly. And I actually don't want to own property. I actually just want to own debt where it's, passive income or residual income each month. If I have to take a property back, okay, we'll sell it at auction. for the most part. But I've rehabbed properties, been a landlord, done all that stuff in the past, and being the bank is awesome.
Great. Well, that's a lot of information to unpack. I think where I'd like to start is on the front end. You're buying these tapes or these portfolios directly from the bank. Now, when it comes to funding those, are you bringing in partners? I don't know, it wouldn't be necessarily a syndication, but starting a fund. What are you doing to acquire the capital needed to purchase these discounted notes?
Yeah, we don't always you don't have to buy just in a portfolio. That's one of the big misconceptions, is that you need to have $5 million to play in this game. And that's not the case. We buy a lot of one-offs from different institutions. So we partner with other people and other people's money, our financial friends. If people have an IRA, we'll borrow money from their self-directed IRA and use that to go buy the deal and get back on track, for 12, 24, 36 months. We are in the process of putting a fund together. That we are working through all those SEC, dotting T's, crossing I's, all that good stuff.
$60,000 in attorney fees before you even started taking people.
Oh yeah. Yeah, it's a little bit more. We're upward to the 75, but it's okay. It will pay off in leaps and bounds. So yeah, we buy these individual assets. It's called a tape, which is just a fancy term for a spreadsheet. And then the bank send us these lists after we contact the right person or the right department. And then we can cherry pick. We can pick 1, we can pick 10, we can pick 20 and make an offer on there and go from there. The biggest portfolio I've ever bought was 250 assets at once. And then I bought one note for $7 before and flipped and wholesaled it for $5,000 profit. So it's a good mixture in between.
So when you're pulling in these portfolios, you're not necessarily buying the whole portfolio, but you do that. And are you just cherry picking and then you're selling the notes off to the other investors, or how does that process work?
So I'm always buying for my own portfolio first. I've closed on over a $500 million in debt since we started on this, residential and commercial notes. And I'm always looking for my own portfolio. That's the biggest thing. Now if we get a pool in, we'll wholesale we got some students that we'll co-bid with. They want to buy 2 or 3. We want to buy 20. So it's kind of like, they get a bulk discount, by being partnered up with us. Or I'll buy 25. I may flip a couple off, wholesale a couple off, for 1,000 or 3 points, whatever like that. But I'm always looking to buy for my own portfolio, and I'm buying in about 20 to 25 different states out there. And I actually prefer, one of the things that we focus on is we like to buy occupied assets, occupied notes, because the property is usually in better shape and we have a much higher hit rate to get that borrower back on track and reperforming. One of the biggest mistakes I made as a note investor early on was coming out of the fix and flip side and all the debacle from 2008, 9, and 10 was I tried to foreclose on everything initially. And I was paying out money, paying out attorney fees, paying out repairs. And, each state has a different foreclosure time frame. Sometimes foreclosures taking 2 years. And when I look back at it, if I'd have worked to modify more of those or work more with the borrowers, we would actually made a whole lot more money and gotten cash in immediately versus having to outlay a lot of cash and waiting for a bigger payday. And like I said, 12 or 24 months later.
Sure. Okay. So that makes a lot of sense to me. The part that I'm having a hard time wrapping my head around right now is when we do our direct mail to find properties to wholesale or flip, I know exactly what my buy box is. And so if we get deals in that don't fit that, I know that those are the ones we're going to pass the other investors or JV on or do something like that. But I have this buy box is what we call it. And I'm wondering, what does that buy box look like to you? And then are you researching each of these properties, going out and taking pictures, understanding what the asset is prior to acquiring it? Or are you just kind of looking at the numbers, deciding that it's a good thing to take down and then doing the research on the property? How does that process work?
That's a really good question. So we have our buy box of our biggest, our wheelhouse is assets that are at least 50 to 250 in fair market value, where the borrower owes more on the property than what it's worth. We want mortgage payments to be at least $500 a month or greater. We want to be in cities of at least 50,000, prefer $100,000 people population. 3-bedroom, 2-bath. We want at least that 1,000 plus square feet, and rent rates on the property that will vary, but the lowest of the lowest is $500 a month on the rent rate. And that's usually in Detroit or Columbus, Ohio. So usually we want to be at 800 above. So we look at those quick numbers. And when we get a tip in, we'll make offers. It doesn't make sense for us to go out and look at every property before we make an offering, because if we're making 100 offers, we look at the numbers first. Yes, we'll look at online images to see what it kind of looks like. But if we make throw 100 against the wall, the fund or bank may come back and only approve 50. And then we may counter those back based on where they counter back, and maybe at 25. So when we finalize that final number of 2025, then we send out our BPO agents. I love working with agents. They're one of the biggest lifebloods. I'm not one of these guys that says you have to do it all. Agents save us a ton of money and a ton of time. And so we send them out. They're pulling comps, doing external BPOs on it. When you're in the note business, you're not just looking at the property. You're also looking at the borrower, because then we're going to get notes from the existing servicing company who's been had conversations with the borrower. We can see if the borrower's been friendly or not so friendly.
Sure.
And then we also look at the actual loan file, the actual the collateral documents, to see that everything is there if we have to foreclose. We also will see a lot of information like what the borrower did beforehand, what they have for retirement accounts, if they own other real estate. If the borrower has filed bankruptcy, they literally like opening the kimono to us so we can see everything that they're into and see what kind of fit they might be for a modification or reinstatement. And so that's kind of the three-pronged approach to looking at that. And if the asset passes those three, then we'll go to foreclose. But let's say the value, we think of a value in assets 100 based on what we look online, and it actually turns out to be 50K. Well, we can kill that deal just by saying value didn't come back where we want it, or we can fade our bid or reduce our offering to the bank or the seller. So listen, if value came back at half, we're going to reduce our bid by half. Take it or leave it. If you don't like it, then we can do it. So we may end up out of that 25, we may end up at 5 or 10 that we really, really love and go from there.
Right. And how are you basing that offer? Are you, in the fix and flip world, you have 70% minus repairs. What is the note investors, general rule of thumb?
Yeah, so that's one big thing. We're not a real estate investor. We're a bank. So you have to approach it with a banker's mentality versus a fix and flip mentality. Otherwise, you'll way overpay and get yourself in trouble. So like we don't have ARV does not exist in our world, because we don't want to take the property back and fix it.
Right.
Okay. Now I'll do that in Texas and Florida, my two bigger markets, for the exception, but ours is all about as is property, and then the UPB, the unpaid principal balance, and then the payoff or legal balance. What's the total payoff amount? Now, if the borrower owes more than the property is worth, then we go off the lesser of the two, which would be the fair market value. And we want to be usually below 60% of the fair market value. It's usually, and if we can get below that, which a lot of times we can, great. If the borrower doesn't owe more than the property's worth, where they actually have some equity, we don't want to chase equity deals, because as the bank, we're only going to be able to get really what the payoff is. And most banks, when there's equity, they're going to want us to pay somewhere between 80 to 90% of payoff. And that just doesn't make sense for us to do that. And whereas a lot of investors chase equity deals, we don't, because that equity does not belong to the bank. It belongs to the borrower. So like if you've got a borrower who has a house that's worth 200, they only owe 150, the bank may want us to buy that at 95 cents on the dollar of the balance. And that would only be like a 5 to 10% profit. If it's sold at the foreclosure auction, for us to collect, our highest bid would be the 150. If it's sold for 180, 190, that 30, 40 grand goes back to the borrower. So we like underwater deals. It also takes away a lot of, I guess you could say, heartache with the borrowers, because if they've got a ton of equity, they're going to fight you and drag things out for that equity. Where they're underwater, we look like the white knight coming and said, listen, Mr. and Mrs. Barr, Melissa, I know you haven't made your mortgage payment in a year. What's going on? Are you back to work? Can you get back on track? Okay, great. Pay 12 months of payments to us on time, a little bit extra. At 12 months, we'll recast your loan or modify it. If you owe 175 and the house is only worth 160, we'll forgive that 15 grand after a year. But you got to make payments on time for a year to us to recast it and go from there.
Sure. And when you're buying it at a big discount, you can provide that. Really, you're still able to provide a solution that the big bank doesn't have time to offer, or the servicing company doesn't have time to work out. So I think that does serve them. And then a lot of times it's not going to be like that. And you guys are going to be able to make your profit in there. I guess this rolls into my next question, or what I'm thinking about with all of these forbearances coming due and all of that kind of stuff. How does that play into the note investing side of the house?
It's a beautiful thing because when people aren't making payments, it means more inventory for us, right? You know, and Melissa, are you guys seeing an increase in like short sales or distressed listings in your guys? Not yet. Okay. It's coming. It's the reason you're not seeing that is because companies like me come in and buy the debt, and then we negotiate with the borrowers to keep them in the property.
Sure.
Now we do a lot. We do short sales. I mean, I'm the fastest short sale negotiation company settlement in the world. Give me what I paid for the note, what you owe. Okay, approved. As long as the spread, let's get this thing closed versus it taking 9 months through Equator or something like that. So
the bank's already taken that loss on that. So for you, you're not taking a loss usually.
No, yeah, exactly. I don't want to buy a note where I'm going to take a loss on. We're always going to buy at a point that we're going to, depend on the timing, and it'll vary on the state too, the foreclosure time frame. Like New York, New Jersey, we don't buy a lot there because it takes 3 years to foreclose in New Jersey. I mean, in New York, 2 years in New Jersey, and 10 grand, and you got to hire an attorney to talk to an attorney to have an attorney up there.
Right.
So we like states that have, usually less than 12 months to foreclose. I don't buy a lot in, forgive everybody, I don't buy a lot in Chirac or Crook County, Illinois, you know what I mean? Not fun to foreclose if you don't live there in the area, but there's other areas out there that are really great. And if any of your listeners, anybody's out on the West Coast, they're like, oh, can you buy notes in California? Yes and no. Yes, you can buy them, but you're going to pay through the nose because everybody knows, it's so overpriced out there, kind of like it is here in Austin. But there's a lot of better deals. For what I would pay for like one property in San Diego, I could buy like a block in Kansas City or a block in Jacksonville, Florida, and leverage my risk out across those in a lot more effective manner.
So I just have a quick question, if that's all right.
By all means, go ahead.
So I'm just interested from the business side of this. How do you man a business like that? Like, what does that look like? How many people do you have reviewing, that kind of things?
So most real estate investors, raise your hand if you're a control freak. Everybody in real estate is pretty much a control freak for the most part. With note business, we leverage vendors. We're like a general manager. You guys football fans? You a fan of any big football team? Like who? Like the Cowboys? You're Cowboys fans? Is that right?
No.
Okay.
No.
So like I'll use the Cowboys, for example. Jerry Jones, he's the owner. He's not out there slinging Miller Lights and hot dogs. I mean, he wants to coach, but he's not coaching. He's up there directing people to do that. And that's what we do as note investors. A lot of the heavy lifting and the borrower outreach and the communication with the borrowers is done by third-party servicers that we're paying, $15 a month if it's a performing note, or $90 a month for them to call on an aggressive, to work with the borrower to get them back on track. If it's not going to work, then we kick it to our real estate attorneys, and they run with the ball and handle the foreclosure process. On the front end side, we're looking at spreadsheets and online values. When we have to do due diligence, then we're sending out agents or people to pull BPOs, and we look at those numbers and go from there. So the beautiful thing is most people in the note space can do this from anywhere. You don't have to be local. If you've got the internet and a cell phone, you can do this whether you're here in Naples, Florida, or Naples, Italy. I've closed deals both places from traveling. It literally comes from that. Now, I've only looked at maybe 5% of my actual properties that we bought or the notes because we get videos or we get views, BPOs, like I said, comps from the local agents or other investors to take a look at it, and that helps us determine value as well.
Interesting.
Sure. I think for beginning level investors, this seems like something that's so far out of reach or outside of the comfort zone because it's not what everybody is preaching. It's not what all your Facebook gurus and your Instagram real estate superstars are pushing out there. So can you help break it down? If a newer investor was interested in the passive income that comes from notes, where would you direct them to get started, and how could they get their foot in the door dealing with these institutions and looking at this grand thing that is kind of hush-hush in the investor community?
Well, it's not that difficult because if you're working full-time, the last thing you want to be trying to do is flip properties or deal with rehabs and toilets, tins, and trash outs. That's creating a full-time job in a lot of cases. A lot of our investors or students, they'll take 50 grand in their IRA or their 401k or in their savings, and they'll go buy a couple performing notes that are going to perform at 6 to 15% on a regular basis. They may buy a note that was once non-performing, like something that I bought, got the bar back on track, and it's going to sell it now as a reperforming note, make a double-digit return. That's a great place for most people to get started, is buying that performing notes. And you don't need to have, there's a lot of stuff that's under $50,000 that you're buying that's, you're below 70% of value of the asset as well, too, in a lot of cases. So if the bar, no pay, they no stay. You just kick it to the attorneys and let them go that route. So that's a good starting point. If you want to be more aggressive and you don't mind a little bit getting your hands a little bit dirty, then the non-performing stuff is going to be bigger discounts for you. But it's usually going to be a 12 to 24 month period of either buying the note, then working with a bar, getting back on track, then getting that note seasoned for 12 plus months before you sell it off, or you retain it for cash flow. Sure. I had just a student of mine just bought a note in South Augusta, South Carolina, house worth 80, borrower owed 45, had made a payment in a year. He bought the note for $13,000 from a fund. He got an investor to fund 20 grand at 6% interest. So he's only paying the investor $100 a month, sent a letter out to the borrower and got the borrower back on track with the first phone call. So now the borrower is paying $340 a month. The investor is only paying $100 to his money partner. He's pocketed $240 a month plus, $5,000-$6,000 on the front end as well too. So, we buy plenty of notes that are on that smaller side too, because not everything is crazy expensive like it is here in Austin or California, other parts of the world.
That's
sure.
very cool.
That makes a lot of sense. If some of our listeners were trying to find more about you or wanted to take a look at your coaching program, where should we send them?
Really easy. We can go to the mothership website, weclosenotes.com. We've got all our different training. We have a one-day class is a great starting point. It's called Note Weekend, noteweekend.com. If you go to noteweekend.com and enter the code JAM, J-A-M, all right, yeah. Well, I'll give it to you for free. It's normally $100. We'll give it to you for free. It's a replays. We host that class every third Saturday of the month. But we've got that. We've got the Note Closer Show podcast. We do 700 episodes on there every Monday night. For the last 12 years, we've been doing a webinar called Note Night in America. You can go to notenighteamerica.com and join in. But I just, we're here to provide, 1,200 plus videos on YouTube and stuff here. There's a lot of different moving parts to know, just like there was anything else. But the beauty of it is sitting that passive. And as we all know, the banks are the biggest buildings out there because they understand cash flow. The bank always wins, baby. And everybody who's listening to this is already in the note business. If you've got a mortgage, a car, credit card, student loan, Bubba down the street, $50. You're in the note business. You're just on the wrong side of the payment stream. So let's get you on the right side. Let's get you on the sexy side of real estate and become the bank there for you.
If there was just one thing that you would tell the new guys looking at notes to avoid or watch out for, what's that big thing that they shouldn't make that mistake on?
Oh my God. If you have no knowledge, don't do it because you will overpay. You cannot approach a note deal like a fix and flipper. You've got to understand it's a different mindset, but you will learn more from pulling the trigger on your first deal than you would from any class or workshop or podcast as well too. So get educated, understand it, and then don't be afraid to reach out and ask questions. That's one of the biggest things. I get questions all day long from people. Oh, I want to get ready to buy this. Well, okay, let me walk you through that. Does this make sense? Yes, no, then don't do it. Wait, don't get so itchy finger to do a deal because you don't want to pay the School of Hard Knocks, the School of Hard Knocks more tuition. We've all been there, paid there, but there's a ton of information out there and don't be afraid to ask questions.
Awesome, Scott.
Scott, that was terrific.
It was awesome. Much. We really do appreciate you coming on. And I
appreciate you guys. And hey, everybody, if you listen to this podcast, aren't they doing a great job? What is this, 97, 98 episodes, something like that? Everybody, if you're listening, go over, hit that subscribe button, however you listen to podcasts, and then hit that little 5-star review and leave these folks a 5-star review. We as podcasters love to see that. So help them help you.
Awesome.
Thanks, Scott.
We appreciate it. All right, my friend. We'll see you later.
Thanks, guys.
Thank you for listening to the Real Estate Jam. We hope you enjoyed today's episode. For more information, check out our website, therealestatejam.com, or find us on Instagram, Facebook, and Twitter at The Real Estate Jam. If you have any questions, feel free to drop us an email at therealestatejam@gmail.com. See you next episode.